Hey there, folks. It's Brad from Beacon here, and I wanted to talk about really one of my favorite things, Roth IRAs. And there's kind of three, maybe four ways to think about these things. It's drawn in my beautiful illustration here. But there's I'll go through it. First one is getting money into the Roth IRA. How do I put money into it? And there's income limitations, and but I'm going to simplify the process. Let's say you can contribute. You can put $7,000 in a year. You can also convert your pre-tax traditional IRA to Roth and get it into there that way. These are a little bit different potentially on the distribution side, which we'll cover here in a couple minutes. But the second phase of an IRA is the earnings that happens with the monies that you contribute. This all happens tax-free in the vast majority. There's a couple investments that you probably should not have in your Roth IRA. Again, a different thing for a topic for a different day, but your stocks, bonds, for the most part, those are all good to have there. But those earnings happen tax-free, whether it's dividends, interest, capital gains. So you don't have to pay a tax bill. If you've ever, gotten your W-2 or done your tax calculation, right, and you think everything's good, then you get that interest statement from your high yield bank account, and now you all of a sudden, oh, if that growth happened in a Roth IRA instead of your bank account, there would be no tax, and that's the advantage. I'm not saying do that, but that is the tactical advantage to a Roth IRA, one of them. And third is getting the money out. How do you actually use that money for whatever it is that you would like to use it for? And of course, I work with a lot of entrepreneurs. The Roth IRA offers a lot of flexibility for getting the money out, even if it's not qualified. Now, what is qualified? And a reason why I encourage everybody who's able to open up a Roth IRA and put money in it literally has to do with what the IRS includes as qualified. You could be as old as Methuselah, well above 59 and a half years of age. But if this Roth IRA is not 5 years old, it's not qualified. It's automatically no, and then you pay an accountant such as myself or somebody else to lots of money to do a basis reconstruction to try to get that money out tax and penalty free. So there's other criteria that have to be met in addition to the 5-year rule, but it's easy. Just contribute $100 to the thing if you're able to do so, and you get out of that 5-year rule when in 5 years. But if you are not, if the 5-year rule isn't met, and or it's not a qualified distribution, let's say you're not 59 and a half, you're not disabled, no first-time home purchase, you don't meet any of the criteria, there is another advantage. The first dollars that come out are actually the dollars that you contributed to it. Doesn't matter when, those are the first that come out. So this contribution, those are tax and penalty free. The second dollars that come out have to do with this conversion piece. Those may be penalty free. You've already paid tax on it. Those may be penalty free depending on whether those conversions happened 5 years ago or not. They have their own 5-year rule. And again, this is for non-qualified. If they are qualified because you meet these criteria, you're good. The third will be earnings, and more likely than not, those are going to be subject to tax and penalty. This would be that interest earned, for example. But it would take a while, hopefully, to get there. And of course, if basis is tracked, and these things are tracked with your accountant on your tax return, it will make life a lot easier. Now, when should you take money out? Should you take money out? That depends on what your life goals are. And remember, I am an accountant, not yours. So speak to your financial planner about more guidance from here. But until next time, have a lovely day.